Morning, Matthew. Justin Brown, Managing Director at Element 25. Element 25 have just delivered the first stage of a multi-stage manganese project in the southern Pilbara, and we've transitioned in the last 12 months from explorer to producer and looking to grow beyond that aggressively.
Justin Brown, welcome back, sir. It's been almost a year. How have you been?
Been well, thank you. It's been a pretty interesting, exciting, and some might say turbulent time in global sort of business markets, but we've done well.
You've had a bit of lockdown to deal with as well along the way. How are you coping?
We have, although Western Australia's been something of an oasis, to be honest. So we've enjoyed the benefits of that. We've been very fortunate.
Good. Okay, so you moved from developer to producer. It happened. Well done.
Thank you. Yeah, I think when we last spoke, we had a vision. That vision is now reality. So we're pretty excited about that, and we're pretty excited about what the future holds.
Okay. Well, you had a 3-stage plan, if I remember from last time. I think you've delivered stage 1. So should we talk about that first in terms of what that took to actually get that going? Because it happened in fairly short order as well.
Yeah, it did. So I think when we last spoke, we were still looking for a funding solution for stage 1. We identified a low capital cost module that we could build without sort of damaging the company share structure. We did that for about $20 million, all raised in equity. So we have no debt. We have our first operational module. We have our first cargo shipping out, and it's reality now. So it's been a great 12 months for us.
Yeah. So, okay, you got the first cargo shipping out. I mean, tell us a bit about that. So how much, where, what's it mean?
So we did an offtake arrangement with OM Holdings. OM Holdings have a smelting facility in Sarawak, Malaysia. They have a take-or-pay obligation to us for all of stage 1 over the first 5 years of the project. That material will go into the silica manganese market. So silica manganese is an alloy, an intermediate alloy that is used in steel, and the primary input for that is obviously manganese. Our ore is perfectly suited to that. They will take the material, smelt it, produce the alloys, and sell that into the steel mills. So volume-wise, this cargo is 27,000 tonnes. It'll ship out of Port Hedland in the northern part of the Pilbara, Western Australia. And nominally we'll ship about 30,000 tonnes a month going forward.
Right. So this is the starter pack, as it were. This is the proof of concept, a product into market. And so remind me of the terms of that deal again, please.
So they take all of stage 1 up to 400,000 tonnes per annum. Our nameplate is 365,000 tonnes per annum. And we hope to exceed that, obviously, once we hit our straps post commissioning ramp up. Beyond that, we have control over the material, but they have a take or pay commitment to that first 400,000 tonnes over the first 5 years.
Right. And do you make money on that?
We do, yeah. So the feasibility stages, the impacts, I guess, of the variables are around manganese price, forex exchange rates, and the like. But based on the assumptions in the PFS, we make about 30 million Aussie in free cash per year from that module.
Right. Okay. Fantastic. And over what period? Sorry.
So the initial mine life is about 40 years, but bearing in mind that only uses about 20% of the global resource. So obviously prime for expansion beyond that, which is our intention.
Right. And so how many other contracts or how many other conversations are you having about contracts at the moment? Because you want to be dependent on one, client.
Yeah. No, it's a fair point. So I think it's fair to say the appetite for the concentrate that we produced was strong. We had a number of parties in the room, most under confidentiality, so I can't name them, but they were genuine, well-known players in the manganese market space. So we have good appetite for the material and don't think we're at risk, of not being able to place additional material as we produce it. We're close to the markets. I mean, most of this stuff gets consumed in Southeast Asia. Our competitors are in South America or South Africa or Eastern Europe. We enjoy some nice proximity to the customers, and they also like the fact that we're a West Australian-based mine site with the benign geopolitical environment that sort of comes with.
So what's happening in the market at the moment? Obviously, people, you mentioned obviously alloys as already, but people are talking about EV and battery thematics and substituting in manganese into new battery designs, etc. So I guess the future sounds nice and rosy, but today, with the competition that's out there, what's happening with manganese price? Because it's plentiful, but you've still got to deliver it to clients. So how are you managing?
No, you do, and I think that's a really important point. So if you look at the global shipping environment as one sort of part of the logistics supply chain for manganese and other bulk commodities, it's extremely tight. Shipping prices are up. And what that's effectively doing is pushing manganese prices up. So manganese prices are peaking, breaking off their lows and heading north. And I guess one of the advantages of being close to markets is that shipping impacts us less than perhaps our competitors who are much further afield. So whilst, yes, it costs us more, it costs them more than us incrementally. And so, and you're seeing that comes through in the manganese price. Manganese prices are looking really strong and expected to head up. In terms of other things, it's a balancing act. When the commodity boom run is in full swing like it is now, labour markets do get tight, supply chains get tight, so long lead time items potentially take a bit longer. We're battling those things like everybody else. But fortunately, the equipment we needed for stage one was ordered well in advance of the current squeeze, and that was delivered on time and on budget. So we didn't have any impacts there. Going forward, look, there may be more, but look, we've got a low cost basis that we operate from. So I think we can weather those things and make nice profits along the way.
So manganese prices going up, but margins being captured elsewhere. I mean, or are you saying that you're going to be able to capture some of the upside because shipping costs for others will be higher, but not necessarily for you? I mean, you're trying to
exactly.
Tell me that's good news, right?
That's good news. It's relatively speaking good news. So as that manganese price heads up, the impact on our logistics costs is less than competitors. So some of that gets converted to margin for us.
Okay. So the size of the manganese use in alloy at the market, alloys is what at the moment? You're feeding into
look, the total in terms of manganese metal tons, contained manganese, is about 20 million tons a year.
Right. Okay. So it's not huge.
Well, it's the fourth largest traded metal, so it's not small. It's not huge compared to iron ore, but it's big enough.
Okay, so it's fourth on the bulk list. Okay, interesting, fine. And you're going to try and capture what percentage?
Oh, look, it's modest in stage one. If you look at our look at our expansion plans to 1 million tons, just to give it some simple maths for me to do, you're looking at something like 2%.
Right. Okay. It's not insignificant either. And so can we just go into the battery thing? I mentioned it a second ago. We talked about sort of battery designs, and manganese becoming a more important staple, as it were. Are you having conversations with battery manufacturers, car battery manufacturers? Yeah,
no, we are, and I think a little bit of context there, Matthew. Manganese has always been an input in batteries for at least the last 100 years. It's becoming more dominant in the new generation of batteries. So the EV batteries use a cathode chemistry that combines currently nickel, manganese, and cobalt. What we're seeing come through in discussions with potential off-takers is that manganese is becoming a more dominant component of those cathodes in the next generation of batteries. So what we're seeing is announcements from the likes of Tesla, Volkswagen, that they want to move towards a much higher manganese content in their batteries. So if you look at the demand projections for manganese sulfate, which is the chemical form of manganese as distinct from the material that goes into the alloys, demand projections are incredibly strong, exponential, starting to really get going in about 2024. And we want to tap into that. That's perfect timing for our development plans.
And what are the use cases for those batteries then? Because obviously they're going to have to substitute something out, presumably. So what are we looking at?
Yeah, so the three metals that go into the cathode are in the current generations, nickel, cobalt, and manganese. The cobalt side of things is problematic for ethical reasons and the like. The primary producers are in the DRC, which causes some problems from a emissions point of view, child slavery point of view, other ethical concerns, environmental concerns. So a lot of these guys are trying to phase out those kinds of inputs into their battery chemistries. And cobalt is scarce, so it's difficult to get hold of reliable supply as well. And if you're going to build these multi-billion euro gigafactories, you need security of supply. And you need it to be ethical and low carbon. So nickel is the preferred choice right now in the current generation, but increasingly they're finding that more difficult as well because the class 1 nickel supply side of things is tight also. And what they're doing is saying, well, manganese is more abundant, it's lower cost. And there's two things these guys need to do. They need to secure supply and get their costs down. And manganese is showing itself to be the real prime mover in doing that. And so the next generation of batteries from Volkswagen and Tesla will have much higher manganese contents. And that means that those growth forecasts from a demand side are going to be even stronger. Okay.
Yeah, it's interesting times on the battery design for sure. With regards to what you've learned from your phase one operations, obviously you optimize and you try and adapt the flow sheet to give you better margins, etc. So what are the kind of key learnings? Because you've done it in an accelerated way. Okay, you've done it quickly, right? Less than 12 months. It's a good effort.
Yep.
What are the things that you're now going to be able to do better as a result of having gone through that process?
Yeah, no, fair question. I mean, they range from very, very minor things, layouts and things like that, material movements, that sort of thing, but they're pretty trivial. One of the things that we've just trialed is putting a scalping screen in front of the crusher to debottleneck the crusher. That was quite successful and showed us a runway to actually exceeding nameplate on the throughput of the current plant design, potentially, because we found that the crusher bottleneck was not a bottleneck, in fact, for the log washer or the ore sorter as the other parts of the plant. So if we debottleneck the crusher, we can then, for the same capital input, generate more tons through the plant, or a minor incremental increase in capital, we can put more tons through the plant, and that goes to the bottom line with the same labor cost, power costs, etc. So some of those optimizations will roll through into stage 2, and we're understanding where the bottlenecks are and where we need to expand in our various stages and where we perhaps don't need to expand. So we're showing that whilst our base case for expansion was a replication of the stage 1, in fact, we're seeing opportunities to reduce capital below a simple replication. So we may even do better than the PFS on stage 2.
Right. Okay. Well, that's interesting. So stage 2 is about expansion.
Yes.
Looking at some cost savings, and expansion means what to you? Is it just about the throughput? Because you have been producing. It's not quite at nameplate yet, but getting there. So what does stage 2 look like?
So stage 2 is increasing tons in the front and tons out the back. So with better performance on grade and yield in a perfect world. And so I guess our 2 levers really in terms of the economics of the project are getting more tons out the back end and better grade out the back end. Those are the 2 key economic drivers for us. So there's a crossover point with those 2 things. We could put X% more tons out the back end at a slightly reduced grade, or we could put slightly fewer tons out at an increased grade and have more payability. So balancing those 2 is one of the things we're working on. So
you said you're fully funded. You're fully funded to what at stage 2?
So for the nominal CAPEX for stage 2 is another 20 million Australian dollars. We're fully funded to that level.
Fantastic. Okay. And you've got to have some degree of confidence before you press the button on that you've got the ability to sell it into market. Now you can go without contracts, or you go and sign up a few more contracts, or you can have a combination of the 2. I mean, how are you going to play it? Because, we've seen different models, have different results out there in terms of, giving certainty for future fundraising. But obviously you also at the same time want to capture as much of the margin as possible. So what are you thinking?
No, exactly. And I think if you look at stage 1, when we entered into the offtake agreement with Ohm Holdings, part of the driver for that was to get a bankable offtake that we could then take to lenders to secure the funding for stage 1. That was superseded by an equity raising, which meant that debt was not required. So therefore, you could argue some of the benefits that come with offtake were diluted somewhat. Because you do give away something for that certainty, there's no doubt, and we want to recapture that in stage 2. So that's either by tighter negotiations on the arrangements with the off-takers, or we take more into our own control and do more of our own marketing. But that obviously requires we need to build the in-house skill sets to do that effectively. And there's a counter argument that says some of these guys have been professional traders for a long time. Maybe let them stick to their knitting. As long as the terms are tight enough and we're not giving too much away, that's a viable alternative as well.
Right, and we've heard companies actually work with their off-takers to actually go and secure sort of lower cost debt solutions, because they've got bigger balance sheets typically than you. And maybe there's some quid pro quo to doing that. Are those part of the conversations?
No, they are. And look, certainly with Ohm Holdings, it's a partnership approach. We have a lot of conversations about how to add value to the supply chain, and a lot of the time with these types of commodities, it's a value and use proposition as well. So it's things like the silica manganese content ratios and things like that, which mean that it has more value in the smelter and beyond than perhaps a different blend of ores. So working closely with them to optimize and increase the payability of our material and then consequently their material is something that we do a lot of.
Right. Okay. So all easy breezy, no problems. It's been smooth sailing. No.
Well, yes and no. I mean, you could take I could put my TV face on and say sure, but of course there've been headaches. Like any project that's got up, there's been some roadblocks on permitting that we've had to iron out. There's been some labour markets here are tight. I'll give you one example. Getting people is tricky. Getting good quality people is tricky. Fortunately, financing for us wasn't a big issue, and in fact, the capital markets are actually pretty free flowing at the moment. So that's probably the least of the worries of a resource aspirant, but. getting trucks for hauling ore, for example, takes a lot more phone calls than you would expect 2 years ago. These kinds of things. So plain sailing, no. Have we got it done? Yes.
Should have invested in a transport company, eh?
Would have been timely had you done it 12 months ago.
Exactly. Right. Okay. So phase 1, phase 2, you're on it. Phase 3, that's where it gets really, really interesting. But you'll need a stack of money for that, surely.
Yeah, no, you're dead right. So we've done, your viewers may remember from previous discussions, we've been on the high purity manganese journey for the best part of 4 years now. We were early to it, perhaps too early. The EV market hadn't actually got to the critical mass that we needed it to get to yet. It has now, but we're 4 years into the journey of developing the flow sheet and understanding the engineering side of producing a manganese sulfate production plant, which takes our concentrate from stage 1 and stage 2 and converts it to a manganese sulfate, which is what the battery guys need for their factories. That conversion facility will be significantly higher capital cost than the simple beneficiation plant that we're using for stage 1 and stage 2. So financing will be required. In all likelihood, a certain level of debt funding will be required. Love to give you a number. I can't because we haven't done the feasibility work. ASX would crucify me. But to give people a concept, I'm using a 150 to 200 million Aussie type level to give people appreciation of scale, but that's a very loose number.
Right, and what about timing on that?
So we have a target runway of delivery of the PFS this year, delivery of the DFS first half of next year. Alongside that, we'll product qualification with the offtake partners will happen, and then project financing and final investment decisions second half of 2022. That's our current timeline. Delivery of the project 2024.
Okay, it's been a really good reaction in the market. I mean, you're up 5 times from when we spoke a year ago, right?
Yep, a fantastic year in the market. And look, I think that's testament to what we've achieved. I think people have shown some sort of confidence in what we're trying to do by the virtue of the fact that we've delivered what we said we would deliver. I won't lie, though, to be honest, I mean, the rising tide raises all boats. I mean, commodities are a great place to be right now, so we've benefited from that as well.
Yeah, you have, and it's come off again recently, and that, I guess, reaction to the wider general market reaction to, I don't know, the Fed talking about interest rates, inflation, and those sorts of things last week. So do you think you're kind of fairly priced at the moment? So it's pretty reasonable price.
I think for stage 1, we're fairly priced. I think that's probably reasonable. I don't think there's a lot factored in for stage 2 and 3, to be honest. And I think if you were a savvy investor looking down a slightly longer timeline, perhaps a 2, 3 or 4 year timeline for your investments, then I think element 25 represents fantastic value because we have got a clear vision. We have delivered stage 1 of that vision on time and on budget. We fully expect to do the same for stage 2 and 3. The fruits of those labours will be manyfold.
Why do you say factor 2? Oh, so stage 2 is not factored in at the moment. On what basis? What numbers are you using?
It depends on what you use for if you just use a simple EV ratio. I mean, our mine life at 40 years means that once we hit steady cash flows, you should expect to see an EV-based valuation on the stock as one measure of value. And I would argue that would be roughly where we sit today. I think it's stage 2. If we generate that and we hit our milestones on that, we're heading closer to $100 million a year in operating surplus. I mean, I don't think our valuation now captures much, if any, of that. And certainly beyond that, we're talking significantly high revenues with multiple modules of manganese sulfate delivered over a decade, generating really good leverage returns. So I don't see any of that in the current share price.
Right. And so what are the risks out there in terms of market conditions? Or you think it's all sunshine?
No, I don't think it's all sunshine. I think commodity markets can be volatile. One of the reasons we want to move into the chemical space is because you're sheltered from that volatility, and your margins are much better protected. So I think it becomes a different kind of business when you go down that path. I think if you stick to just manganese concentrate, you will be subject to the volatility of commodity markets. I think if you stay there, you'll suffer that. You'll enjoy the highs. You'll also have to work through the lows. Becoming a chemical company, different game, and I think we'll do better. Okay, so what does this year look like in terms of the finances? Do you become net positive cash flow this year? Or was that? Yeah, that's the fully expected to become net positive cash flow. Okay, so even if stage 2 takes a little while to actually be realised, what do you do with the cash you're generating from the stage? So a decent chunk of that is going into finalising the flow sheet optimisation to qualify a product for the off-takers, pilot testing, engineering design and delivery of the feasibility studies around the sulfate. There's a decent budget being allocated to that. The rest of it is being allocated to the stage 2 expansion plans, we're not talking dividends at this stage. Dividends will come later. Everything that we generate will then provide the equity piece for financing for stage 3, which will likely be accompanied by some debt funding, either from an export credit agency or a group like NAIF. Look, then once we build that and become a profitable manganese sulfate producer, we'll look at the next module of manganese sulfate. So it's a pretty aggressive growth story for the next 5 years or so.
Yes, it's an aggressive growth story for sure. But with the numbers that you're banding around with regards to stage 1 and stage 2, why would you even need debt financing for stage 3? Seems to be tens of millions of dollars.
Just because of the speed of delivery. Speed of delivery and beyond stage 3, we've got stage 4, stage 5, stage 6. We don't want to put the brakes on anything.
Right. Okay. So you think that's the best way to go at it? You're going to have enough equity.
I don't want to wait till the piggy bank's full to the tune of the capital we need for stage 3. I think we can do it better and faster and use a little bit of gearing to improve the outcome.
Okay. What's stage 4?
Stage 4 is a replication of stage 3, but bigger.
What's stage 5? And keep going.
Rinse and repeat.
Okay.
I think if you look at the growth curve for demand for manganese sulfate, we won't be able to keep up, Matthew, to be honest. We won't be the only player in it because we won't be able to satisfy the market ourselves. We can grow as quick as we need to, and the market will stay ahead of us. So there's lots of opportunity for us there, and the ore body is big enough to support that.
Okay. There you go. There's the update. Appreciate you coming on and letting us know what you're up to. I mean, what should we be looking at for the next 6 months? Just some clear?
Yeah, look, I think tangible outcome on delivery of the first cargo, second, third, and fourth cargoes, and so on. Expansion decision milestones on stage 2. The metallurgy, engineering, and marketing discussions with offtake partners on stage 3. Delivery to PFS, DFS, and then ultimately project financing and delivery. So lots of news flow
in an accelerated time frame. Okay, brilliant. Justin, I appreciate you coming on and giving us that update. It's been a good year for you. Stay in touch, okay?
Thanks very much. Appreciate your time.